Have you ever thought about what would happen if the stock market crashed tomorrow, or if the world's economy was driven to ruin by monetary policy? These are big, important questions that we should all be thinking about, especially in light of recent events. Speaking of recent events, let's talk about Credit Suisse. Now, I try not to say anything negative about them, but when I look back at my old videos, I seem to keep mentioning them. And with good reason. Credit Suisse is one of the largest banks in the world, or at least it used to be. Over the past 15 years, it's lost about $100 billion in market cap and is now only the 155th largest bank in the world. To put that in perspective, it's about the same size as Webster Financial in Connecticut, or Crocs, the company that makes those rubber clogs. This week hasn't been a great one for Credit Suisse. Its biggest investor was asked if he would buy more stock in the bank, and he said absolutely not. Not the best thing to say when people are already suspicious of banks. As a result, the share price fell as much as 28%, the biggest one-day sell-off in the stock's history. Its bonds also fell to levels that signal financial distress. The news that the Swiss National Bank has given Credit Suisse a $54 billion loan, and the bank's announcement that it plans to buy back about $3 billion of its own debt should come as a relief to investors. The infusion of cash should boost the bank's liquidity, making it better able to weather any financial storms that may lie ahead. It is also encouraging that Swiss regulators have examined the bank and found it to be in good shape. While Credit Suisse has had its share of scandals and mistakes, it is reassuring to know that it has a strong and liquid balance sheet. In terms of numbers, the $54 billion loan from the Swiss National Bank is a significant amount, and it indicates that the central bank has confidence in Credit Suisse's ability to repay the loan. The $3 billion buyback of its own debt is also a positive sign, as it shows that the bank is taking steps to reduce its liabilities and improve its financial position. Of course, there are still risks involved in investing in Credit Suisse, as there are with any financial institution. However, the news of the loan and the debt buyback should help to calm investors and provide some stability to the bank's share price. So what can we learn from this? Well, for one thing, it's important to pay attention to what's happening in the financial world. We can't just ignore it and hope for the best. And for another thing, we need to be careful about what we say, especially when it comes to important matters like the stability of our banking system. We can't afford to make mistakes like that. In the last quarter of 2022, the wealth management business of Credit Suisse saw over $100 billion in outflows, which is a huge setback. While the actions of the Swiss National Bank have helped to avert disaster for now, Credit Suisse is still possibly critically wounded. The situation worsened recently as the bank's bonds slid further, with some trading below 70 cents on the dollar. This is generally considered a marker of distress, and the same bonds had been trading in the 80s and 90s just a few days ago. Even the share price recovery on Thursday was driven by short covering, as the short thesis is now a lot weaker than before. Despite these challenges, there are reasons to believe that the European banking system is in a better position to weather the stresses of the current environment than U.S. regional banks of similar size. European regulators have a detailed set of standards for testing interest rate risk, with the idea that they will be applied to every significant bank in Europe. Unrealized losses are not ignored under this regime, and the global Basel standards on stable funding are applied across the entire banking sector. This is quite different from the regulations applied to community banks in the United States, which have lobbied the government for regulatory exemptions over the years. European banks have underperformed U.S. banks since the credit crunch, largely driven by this additional regulatory burden. But the idea is that if regulators are going to agree to bail out banks from time to time, they should reasonably put restrictions in place as to how much risk these banks are allowed to take. But let's get back to Credit Suisse. While its balance sheet is reasonably strong, its reputation is obviously not. The unending list of scandals, most of them coming from the firm's senior management and its investment banking division, have destroyed the once impressive brand. This loss of reputation has driven away top talent and the firm's customers, resulting in collapsing profitability. So, what's next for Credit Suisse? With the Swiss National Bank backing the institution and its balance sheet in decent order, it seems highly unlikely that liquidity issues will sink the ship. This makes a Silicon Valley Bank-style bank run way less likely. However, while a central bank can provide liquidity, it can't provide a good business model. And that's what Credit Suisse needs. Customers have to see a good reason as to why they should choose to deal with a tarnished brand like Credit Suisse. The bank needs to reevaluate its business model and find ways to win back the trust of its customers. Without a solid plan, it's hard to see how Credit Suisse can recover from its current crisis. In the next video, we will discuss with an expert the implications of this crisis on the banking industry as a whole. We'll take a deep dive into the challenges facing financial institutions today and explore possible solutions. Stay tuned for an insightful conversation that's sure to provide some much-needed clarity on this complex topic. In conclusion, the challenges faced by Credit Suisse are not unique to the bank, but rather reflect the broader challenges facing the banking industry as a whole. In recent years, banks have struggled to regain the trust of their customers and to navigate an increasingly complex regulatory environment. The events at Credit Suisse, including the Archegos and Greensill scandals, demonstrate the need for financial institutions to reevaluate their business models and practices. Banks must focus on building a culture of transparency, accountability, and integrity to regain the trust of their customers. This will require a shift away from short-term profit-maximizing strategies and towards long-term, sustainable growth. Additionally, banks must invest in technology and innovation to stay competitive in a rapidly changing financial landscape. The challenges facing Credit Suisse should serve as a wake-up call for the banking industry as a whole. If financial institutions do not take decisive action to address these challenges, they risk further eroding customer trust and damaging the reputation of the industry as a whole. However, if banks are able to learn from the mistakes of the past and adopt a more customer-centric approach, there is reason to be optimistic about the future of the banking industry. Thank you for watching. If you found this video informative and valuable, please consider subscribing to my channel and clicking the notification bell to stay updated on future videos. Also, feel free to leave a comment below with your thoughts and questions on the economic trends discussed in this video. Together, let's continue to learn and stay informed about the latest developments in the world of economics.